To OETV. We are live here with Jeffrey Hughes, founder at Alpha Insights. Jeff, welcome back.
Hey, great to be here, Mehdi.
So, I want to say welcome back from your vacation. You missed a pretty tough week last week all around. I'm sure you might have kept an eye on it. We did have a small bounce yesterday, but it's feeling a little tenuous again as we speak this morning going into the open. So lots to talk about, lots to catch you up on, and you can catch us up on as well. So, you published your piece on Sunday. Let's dive right into your top down.
Absolutely. Well, admittedly, we were a little jet lagged before we began going through and putting the note together. I think I landed Sunday at noon in Minneapolis and published at 6. And I really started thinking about, a lot of what I was going to talk about in this note on the plane. And, part of it, I really didn't have enough time to really dig into it, in terms of what the implications of FedEx's earnings warning on Friday was. But, I think last week's kind of plunge on in response to, data that continues to indicate growth is slowing dramatically, as well as inflation holding persistently high, not expanding dramatically, albeit the core inflation numbers were well above consensus. But all of that has coincided with the position of the market, such that we expect the setup here is pointed hard down in the days, weeks, and perhaps months ahead. In fact, we've looked at this from a number of technical perspectives, and the S&P 500 had been dancing along the 3,900 level, which was a support level that I thought would be a battleground, and it failed. The breakdown below 3,900 and the rally back into it, I think, is potentially the kiss goodbye. Our expectation is that we are at the precipice of a third wave decline. That's a primary wave 3 decline in force, and that could carry the S&P 500 to at least 2750 by late October, early November. So we've thrown a few dates out there in the past, October 25th, November 8th. We're sticking with those. We are advising clients to raise cash to the maximum allowable level and minimize equity exposure to the minimum allowable level by your mandate. We think at this point, you do not want to be exposed to equities. The next shoe to drop will be massive earnings revisions to the downside, and the market will re-rate considerably lower. And we think our technical setup is really citing that exact case. 2750 by late October, I think, is really what investors should expect.
Well, Jeff, I'm not going to ask the type of vacation you had, because generally people come back a bit more bullish after they've had a couple of days off and recharged their batteries, but certainly not the case for you. Looking at some of your charts, you touched on it just then as well, economic growth. We obviously haven't been put in an official recession, but what are your thoughts on the economic outlook at this point?
Well, yeah, there's no question economic growth has collapsed in the first half of the year. That's in terms of real economic output. Nominal growth has been high, right? But so is inflation. And so, they cancel each other out. And what we saw in the first quarter was down 1.9% real economic growth. We also saw second quarter come in down 0.9%. And that was revised upward slightly to down 0.6%. So now we've been watching third quarter develop using, the Atlanta Fed's nowcast model, which has been, a great way to kind of see how the data is affecting the ultimate outcome in real time. And, looking back 2 weeks ago before we departed, the third quarter nowcast was looking for 2.6%. But as of Sunday night, it's at 0.5%. So we've seen a dramatic collapse in expected third quarter growth. We would not be surprised to see a third consecutive quarter of negative real economic output by the time third quarter GDP is reported.
And let's have a look at inflation, because obviously last week we had the inflation number came out, which was, it wasn't the best indicator for a happy scenario. What are you seeing in the inflation dashboard at this point?
Yeah, so this is a measure of core inflation, right? There's 9 Federal Reserve banks. They've all undertaken their own approach to calculating core inflation. That's ex food and energy, ex volatile commodity prices, and really focusing on those more sticky items in the CPI in order to get a sense of where you know the core inflation really is, and how it's affecting consumers' ability to spend. And the Fed likes to focus on this personal consumption expenditure, the core PCE, which has been kind of holding in the mid 4% range, around 4.6. That was down from 4.8 last time it was reported. So viewed positively, right? But in aggregate, we've been seeing these 9 calculations edge up. They're now some 431 basis points above the Fed's target rate of 2% core inflation. And so, while we can applaud the fact that energy prices have come down from their peaks of $130 a barrel to the mid 80s, right? We're kind of vacillating in that $80 to $90 range. That's certainly not low, right? But it's lower. And it puts gasoline prices below 4%, which is politically a level that's tolerable, presumably. What we saw in Europe was that the Europeans are dealing with a vastly different set of circumstances. In U.S. dollar terms, they're paying north of $8 a gallon in Sweden and Norway for gasoline. Albeit, most people ride electric scooters around the major cities, but they're big agricultural, and construction equipment countries as well, and those run on diesel and gasoline. And so, at the end of the day, they're not going to be immune to the effects of this from an inflation perspective. In fact, inflation in Sweden's really intolerable. They had an election a week ago, and the first response after the results were to raise rates 100 basis points this morning. So, their funds rate, their government rate is 1.75%. So it's well below ours even, but it's a step in that direction. And so we're starting to see the Europeans respond in kind to this. My sense is that the Fed's really so far behind the curve at this point that any sense of the Fed taking a break from raising rates is probably unfounded at this point. I would be very surprised if the Fed printed anything less than a 75 basis point hike tomorrow at the FOMC meeting when they announce. I think it's possible that they could raise rates by 100 basis points. The problem is, the message that sends is one of panic, and I don't think they necessarily want to send that message. The CME group does a Fed forecast tool, Fed Watch tool, that looks at the odds based on the way the Fed funds futures curve is priced. And the odds are 82% as of yesterday that we're going to see a 75 basis point hike. So I would expect that tomorrow. But honestly, getting to the 3.25% level, the 2-year bond yield, as we talked about a couple of weeks ago in this presentation, is really where the Fed funds rate is headed. And that's tagging the 4% level right now. And it does not surprise me, because I think by year end, we'll see a catch up between Fed funds and the 2-year, and eventually the two shall meet. And that will likely be north of 4%. So that's our thinking at this point.
So, Jeff, also you mentioned the 2-year, but on the 10-year side as well, we're seeing the 10-year yields breaking out as well. Where do you think we can go from here?
Well, we've had, a working hypothesis that, the 10-year's broken out already above its 2018 highs. It's taken out a 40-year downtrend line, and it's, on the precipice of really pushing out from that consolidation. So there were 2 scenarios that we've kind of been thinking out, and that is one that the 10-year bond yield just starts to push higher over the next, say, 12 to 24 months and reaches our target of roughly 6%. The second scenario is that given our thinking on the market, on the equity market, it's possible that the 10-year bond yield could collapse as stock prices collapse, as people, shift or asset allocate away from equities into long-term fixed income, long duration fixed income, and that pushes yields back down toward the rising 36-month moving average, somewhere below 2% again, or toward 2% again. And our thinking is that from there, we would rally to that 6%, but it would take a little longer. It might take as long as 3 years to get there. So I'm not sure that either one of those scenarios is going to play out as I've described it. But the one thing that is certain is that if the 2-year yield is tagging 4%, there's no doubt that the Fed funds rate will reach that level as well. And given where the 10-year is today at 3.5%, that would be a relatively intolerable inversion, I think, from Fed funds to the 10-year being negative 50 bips. My sense is that the 10-year would push higher and maintain a positive spread above the Fed funds rate. And so that kind of confirms our view that 10-year yields are moving higher. And the real question is, directionally, is it a straight shot, or do we pull back first in response to, a market sell-off? And, we'll know in the fullness of time, right? But longer term, looking out the next 2 years, I suspect 10-year bond yields will be closer to 6% than they are to 3.5%.
Wow, that's quite cool. You've touched on it there as well. There's been a lot of, talking heads saying that, the June 17th low that we saw in the market put us in for a nice new low, and we're onwards and upwards from there. Obviously, we've seen some volatility around these levels at the moment, but you think we're going to make a lower low than the June 17th?
I do. Absolutely. Our thinking is simply this, that, the rally off the June 17th low was a counter trend advance. It occurred in 3 waves, an obvious A, B, C. The C wave extended up to the 200-day moving average and reversed hard down. From an Elliott wave perspective, we've, annotated this daily chart that really just looks back to the beginning of the year. Let's back that up one and look at it on a short-term basis. So, the decline from the January high into the June low was really just primary wave 1 down. We've got a good 5-wave count into that low and a 3-wave count out of that low that ended right where it should have ended, between the 50 and 61.8% retracement, below the 200-day moving average, below the downward sloping trend line, and then reversed hard down. That gives us an indication that that was primary wave 2. And our count now suggests that we're putting in a series of 1s and 2s to the downside. So we've got intermediate wave 1, intermediate wave 2, and now minor wave 1, minor wave 2 as of yesterday. We think that kicked back into the 3,900 level. It might push back up a little bit higher into the 50-day moving average. But if not, we think hard down into a third of a third wave decline. It'll be minor wave, intermediate wave, and primary wave 3 down from that level. And that should be a powerful decline that could carry the S&P 500 to at least 2750 before we see any sort of a reprieve in the selling pressure. We think the timing of that is likely to occur between now and October 25th, at the latest November 8th.
Jeff, before we look a bit deeper into the Elliott wave side of things, your tone has become much more confident on this downside. I know you've been consistently talking for about 2250 levels and much more downside than we've anticipated. Are you seeing things from a technical perspective pan out a lot more, almost textbook-like, to feed into what your predictions are?
Yeah, you nailed it. It is very textbook. In fact, our count off the March 2009 low is a textbook cycle wave advance that terminated on January 4th intraday. Since that time, we've seen a textbook decline in wave 1, advance in wave 2, and then the downturn. Really, the only thing that's lacking at this point is a new low. Once we take out the June 17th low, I would expect panic to set in among investors. And it's interesting because institutional investors have been selling. Okay, there's no question. Retail investors have been buying the dip, and so and I think to some extent, technical, or I should say, hedge funds have been buying the dip as well. And I think it's been more on the technology side, trying to buy some of these heavyweight tech companies down 25%. Looking at the long-term fundamental picture, but I think that the shorter-term fundamental picture is quite negative, and the shorter-term technical picture, as we'll talk about in a few minutes, is incredibly negative for a number of the bellwether heavyweight FANG names that dominate the index. And as those stocks roll over, I think it'll take the index hard down. And so we've kind of laid out or mapped out what we believe will be a 5-wave motive wave decline, which ultimately should terminate around S&P 2250. We see that happening sometime early next year, probably in the first quarter. And we believe that will be the end of cycle wave A, of a 3-wave counter trend decline that will ultimately carry the market substantially lower. We're not going to throw a target for the next leg down, because it'll be followed initially. This wave A down that we've mapped out here will be followed by a large degree counter trend advance, which we'll want to trade. But after that, we see the market going considerably lower, because it's our view that this entire move off the 1932 low is a super cycle advance. And we've mapped it out, in another chart that's not presented today. But super cycle wave 3 topped with cycle wave 5 on January 4th. And if that's true, then this is a super cycle degree correction, which could carry the markets well below the March 2009 lows, potentially. So, we need to be cognizant of, what degree of trend we're correcting here. And to your point, my confidence is increasing. I don't know for certain that this is going to happen, but I think as the data continues to fill in the blanks, we get more and more confidence. What would change my view here is if the S&P rallied above 43.26. And if in fact that happened, then we would move to our alternate Elliott wave count.
Okay, so let's roll on to the alternate wave count. You've broken down the preferred. And before we run into the alternate, can you just weigh out how much percentage weight you'd put on the alternate versus the preferred, or preferred versus alternate?
Well, right now, I think it's 90% is the preferred count and 10% the alternate. That would flip-flop if the S&P broke out above 43.26. That would change my view diametrically. And that's because under the preferred count, it can't trade above 43.26 and have this count be correct. So it would have to be something different. And the first thing that would come to mind is that we're wrong about the January 4th top being the top of cycle wave 5, and certainly not the top of super cycle wave 3 under that auspices. What's more likely is that it was the top of intermediate wave 3, and that we need to trace out an intermediate wave 4 of cycle wave 5 first. And so fourth waves tend to be, the alternation of what the second wave was. And since the second wave was shallow and brief, the fourth wave should be deeper and should be longer in duration. And so we're thinking it would be some type of a triangle, a lateral corrective waveform. And we've illustrated a hypothetical symmetrical triangle. Proportionally, it's maybe not perfect, but what would potentially happen is if we broke out above 43.26, the rally could carry to around 4,600, and that would just be a B wave. So in other words, the low that we saw on June 17th was probably wave A of a 5-point ABCDE pattern, and it was probably the low for that correction. But what would happen is once the B wave terminates around, say, 4,600, it would largely retrace most of that advance in wave C down. And then we would see things tighten up to an apex point, at which point we would expect to see an upside thrust to new highs. And just given the size of the initial decline, we're estimating upside to a potentially 5,400 on the S&P 500. And what that would then do is that would terminate cycle wave 5 and then super cycle wave 3. So it basically doesn't create a dramatic bull case. It defers the bear case more than anything. But bear in mind, this alternate wave count is only relevant if the S&P breaks out and sustains above 4326. I'd say there's about a 10% probability of that happening as we see the market today.
Understood. And looking at some of the market internals as well, these are feeling a little tenuous as well.
You know, I
No bueno
titled
says
market
all,
internals
right?
no bueno. I've got a bunch of clients that say that all the time. And so, you know, I think it's kind of funny. You know, the bottom line is this, the market internals are not funny. The 5-week moving average of the percentage of net advancing issues has rolled over hard down. It's breached chart support and appears poised to challenge the May lows at this point. We would not be surprised to see that happen in the days, if not weeks ahead. Momentum has broken down from its overbought position and is now holding strongly below the median line. And, you know, downside volume was 76% of total volume in the S&P 500 last week. That, I believe, posted a new year-to-date low or matched the one from the prior low, which was maybe a week or two ago. And then the 5-week moving average of the ratio of up-down volume has been cut from a peak of 9.5 to now 2.46. And we expect that to go back down sub 1 based on how the market is set up. So, you know, these internals are not supportive of a bullish resolution. They are more supportive of a continuation of the bear market decline, which we think is now in force, and we believe a lower low is looming ahead.
And it looks like sentiment's following suit as well.
The persistent negative investor sentiment is not a bullish condition. You know, in general, we can look at, you know, extremes in investor sentiment as being, you know, kind of a counter-cyclical or, you know, contrarian signal. But when we reach levels that we're at and remain persistently in those negative ranges, you know, and are unable to reverse those and move to the opposite end of the spectrum, as most recently we couldn't even get above dead neutral in terms of the name exposure index. It got up to around, I think, 71% or something, and, you know, neutral 75% there. Anything below 50 is underexposed for, you know, the cohort of active investment managers that, you know, responds to this, you know, the survey regularly. And so, you know, we think at the current levels, you know, which are now, you know, something around 34%, you know, professional investors have reached a very, very low level of net exposure. And, you know, if we take a look at the individual investors, you know, they're not far behind. We saw the bull bear spread reach a level of around -4% in recent weeks. That has reversed all the way back down to -20%. That's a bounce off the lows, which was, you know, I think down around -30, 32% a week or so ago, and has come back off that level. But, you know, still we're in this kind of persistent net negative investor sentiment, and that does not suggest a bullish outcome necessarily. You know, I think oftentimes when we get into these extremes, people want to predict, well, everybody's on the starboard side of the ship, so, you know, they're going to move to the port side. That's not always the case, especially in a bear market. We can see investor sentiment remain negative for many, many months, if not years. Just take a look back at the last, you know, secular bear market of the 1970s. You know, bearish sentiment lasted for a decade. You know, overwhelmed bullish sentiment by a decade. I mean, the magazine indicator, right? The death of equities on Time magazine was, you know, the ultimate extreme. We haven't seen anything like that. to this point. So I would say sentiment is not giving a bullish signal at this point.
So calling for a sinking ship. Let's have a look at volatility. This is on the flip side, though.
Yeah, so volatility rising is a condition of more chaotic markets to come, and so the setup here in volatility looks like a major base formation, right? We've illustrated arrow up. I guess the number one point that I would make here is that there's no fear in the market, right? The VIX hasn't printed above 40% in almost 2 years. But something has changed since the June lows in stocks. And what we've seen is rising volatility since that. We're now above the 24% level, which if we look back over the last 3 to 5 years, 24% has kind of been the boiling point. When you're below 24%, there was a sense of calm in the markets. When you're above 24%, there was a sense of anxiety in the markets. But there is anxiety, but there isn't fear, right? The other thing is the VIX is now trending above its 21-day moving average, and that has preceded every VIX spike looking back the last 2 years. So those two conditions, following that positive divergence between VVIX and VIX, gives us a lot of confidence that we are setting up for a much higher move in volatility in the days and weeks ahead. And I believe that volatility spike will come once we see a breakdown to new lows in the S&P 500. Then that will, fear will ensue. Investors will then move aggressively to buy puts to hedge, and that will spike volatility. And I think volatility at that point will exceed 40% and potentially 50% before we reach the next low.
All right, so we're seeing deteriorating internals, deteriorating sentiment, and rising volatility. So how about looking at some sectors? Do you have any thoughts on the sectors going into this week?
Well, last week we saw everything negative, right? The defensives tended to outperform the broad market. The cyclicals were just roiling, right? Everything from industrials and materials, which really lagged, to tech and consumer discretionary and telecom services, right? Communication services. Those were the big laggards. On the leading side, it was healthcare, it was staples, it was utilities, energy outperformed. Surprisingly, financials outperformed, right? And I think I said discretionary. Discretionary did slightly outperform the market, but not by much. And so, I think some of that had to do with Tesla, which is a large component of the discretionary space. And Tesla's been holding up. It's been a surprisingly stable stock among the FANG plus names. And it's not a big surprise to see staples, healthcare, and utilities, as the leaders, because those have less volatility. There's been a rotation into that. It's a relative strength leader, but not an absolute leader.
And so what do we do? How do we make some money in this? I want to say give us a bull bear call, but this is looking slightly different this week.
It is. It's been a while since we haven't been able to find a single stock in the S&P 1500 that merits, being added to our top actionable trade ideas. There's a few that, we wouldn't rule out as having potential upside, but I wouldn't say that they're necessarily actionable. And so this list is really to say, this is what we want to trade this week. I don't see anything in the S&P 1500 that I want to get long, okay, especially into this setup. But I do see quite a few names that I want to be short, and none jumps off the page more than Alphabet. Alphabet reports October 25th. We've been talking about that day as a possible low. Our sense is that, maybe this stock is going to have some news on October 25th that could potentially reverse things. But, I don't necessarily know that that's going to be a low. It might be an acceleration to the downside. What it is a Montgomery cycle turn date. And they don't necessarily reverse course. They sometimes accelerate an existing trend. And so, it's quite possible that we get an acceleration off of that level into the election, and that the November 8th turn date is the real low. But the thing that I think is compelling about this as a short idea is you've got a stock that is a classic pattern top formation of the inverted head and shoulder, or I'm sorry, inverted cup and handle variety. So you can see that it's a cup and handle flipped upside down, and it's 2 years in the making. And so this is a very large degree pattern. We've broken the uptrend clearly. We've now broken chart support, and that breakdown below 107. I think the stock went out yesterday a little bit above 103. The breakdown below 107 gives us the ability to count from a technical perspective a target of $65. Now, we would set this as to set up a good risk return on this stock. I think you set your stop loss provision at around 112, and that gives you a 4-to-1 positive risk skew. Four times the upside to the downside, right? And so that's what we like about the setup. It's a lower risk, 4-to-1 positive risk skew, big pattern breakdown, and relative strength is collapsing in Alphabet, and we would not expect that to reverse anytime soon. So this would be our number one short candidate going into this week, going into the rest of this September, October, seasonally treacherous period that we think will result in a clear malaise in stocks.
And just to clarify that, Jeff, you're calling $65 on Google or Alphabet?
I think so, yeah.
Okay, brilliant. Jeff, thank you so much for sharing your thoughts. Welcome back from vacation. There's a lot to digest here, and I'm sure we'll see over the next week or two how things pan out. But thanks for your time, and thanks for your thoughts.
Always a
everyone
pleasure.
watching, so thank you very much for your time, and good luck investing.